Hello, welcome. Thanks for tuning in to the next session in the Small Business Management series. I'm Nathan Owens from UC San Diego Extension. Today we are going to cover an important topic for businesses, the most important things you need to know about accounting. So let me give you the quick overview of today's schedule, and I will then turn things over to our speaker. So I'm Nathan Owens, Associate Director for Strategic Initiatives at UC San Diego Extension. I've been organizing this webinar series over the last couple of years, primarily as a service to the small business community. It's an important function and part of our mission here at UC San Diego Extension, and it's also a great way for people to find out a little bit more about what UC San Diego Extension is and what our instructors are like and what sorts of topics they cover. So it's good for us, and it's good hopefully for you as well. This session is being recorded. The idea is that we want to make sure that as many people as possible have access to the information that we're going to share with you today. So after a few days turnaround, we'll get this session posted on our YouTube channel, and I will email everybody with the link for that. So that way you can refer back to it if you need to. We will also provide a copy of the speaker Dan's slide deck for you, and you can use that as a resource as well. As for our speaker today, his name is Dan Goldzband. He is an extremely experienced individual. He has worked in a number of different industries with a number of different companies such as Bank of America, Carl Zeiss, General Dynamics, BioLegend, and unfortunately for us, he has been an instructor of finance and accounting at UC San Diego Extension for over 20 years. So thank you, Dan, for your willingness to be our speaker today. Greatly appreciated. And if you want to expand on that intro when we turn things over to you, feel free to do so. As we get into this, feel free to type any questions that you have in the chat. Dan is happy to, if there's a major clarifying question, we can interrupt and have that question be asked to him, and so that way he can address it right then and there. But primarily, we want to hold off towards the end. We're going to dedicate definitely time for your questions to be addressed there. So anytime you have questions, feel free to type them in chat, and then we'll get into them towards the end. Just a quick note about Extension if you're not already familiar with it. We are the professional and continuing education arm of UC San Diego. As I mentioned before, we do a lot external to the university as far as community outreach, community service. We're there to be a resource for pretty much everybody at any stage in their life, whether they're a current student or not. So we have, as you can see on the numbers there on the side, a huge number of courses, a huge number of students. We're essentially a university within the university. And if you're curious about what sorts of courses we offer, or if you want to find out about the courses Dan teaches, you can go to that website listed there in the corner, extension.ucsd.edu, and you can explore a lot of what we have to offer. For this series, I do have a couple of partners that when I have been running it in person for the previous couple of years, they hosted the sessions at their locations in downtown San Diego. So I want to thank and acknowledge both Downtown Works and Cross Campus for their support over these past few years. And I do hope at some point we can return to running the sessions in person at their fantastic locations. As for what's coming up in the small business series, I just confirmed the next session yesterday, so I don't have the registration page posted yet, but I will soon. So this is going to be a session dedicated towards storytelling and the importance for particularly startups to effectively communicate the mission and purpose of what they're doing to their customers. So I will have that up soon, and that's going to be on August 20th, which is a Thursday, and we're going to keep to our regular 11 to noon time slot. Some colleagues of mine are also running a parallel webinar series on leadership and management issues, which is also something that's important for startups to be aware of. And those are some sessions that are coming up in July, and there are more scheduled into August. If you want to find out more about what's going on in the small business series, here's the website for that. I will post it in chat along with the leadership and management essentials series, so you can feel free to check that out. And then lastly, I try to source the topics that get covered in the series from the community itself because I want to make it as relevant and important and valuable to you. So if you do have suggestions or ideas or things that you would love to see covered, perhaps it's something you've wondered about and you want to see if you can get an expert opinion and some advice and practical tips, let me know. And with over 1,000 instructors, people like Dan and others, I have a pretty good shot of being able to put it together. So please feel free to reach out to me and let me know. So with that, I will stop my part and I will turn things over to you, Dan, and let you take it from there.
Well, hello, everybody, and welcome to this webinar. I'm Dan Goldzband. I think the introduction was an adequate description of my experience, a lot of companies and a lot of industries, including some entrepreneurial work, which I know is close to the hearts of many of you. I'm very pleased to be part of this as part of the UCSD Extension outreach. As a personal note, I just might mention that 3 generations of my family here in San Diego have been in some capacity or other adjunct instructors with UCSD. My father at the medical school, my wife at the old crafts center, myself with extension, and even my daughter as a tutor in the writing lab summer. So we have a long history with UCSD, and I'm very pleased to be part of it. I will also say that we've seen so many talking heads on the news since the shelter-at-home practice began. I apologize for the fact that I don't have a more impressive background, but unfortunately the really good-looking bookcase with all the impressive books is off to my left rather than not behind me. So I'm afraid you're stuck with the view of our rather cluttered study. I hope it doesn't distract you. Finally, I want to start by taking a poll of all of the participants because I like to know what kind of audience I'm talking to. So Nathan, would you like to initiate that? And we'll give you about 30 seconds, ladies and gentlemen, to indicate your answers. Okay, anyone else want to register? Oh yeah, the results are still coming in. But I think we can start to characterize them. It seems that about half of you are just exploring this topic. A little over 1/3 of you are entrepreneurs with a company that is actually operating, and I measure that by whether you've actually sold things to customers. And the remainder are either forming their companies or still defining their product or service. Very well, thank you very much. That's good to know. That's good to know. I'm going to close that. Here is the summary of the presentation. 3 sections. The first, and they go from micro to macro. I thought that to make this most useful to you, we might start with a topic that probably is most relevant to you as operators, and that is the costing of the product or service you provide. After that, then we'll step back and start looking at this in a larger sense under the topic of using accounting effectively. I think this is a topic that a lot of entrepreneurs could use assistance with, to be frank. And finally, we'll end up with a more esoteric but equally relevant point, accounting's role in creating sustainable value. And that relates really to the role of the entrepreneur and business owner as a whole. We will break, as Nathan said, for questions after each section. If in the process of going through a section, there's a point that you need clarification for right away, by all means, type your question into the chat. We'll both be looking at it. But if you have a larger, more interpretive or an implication type question, hold that if you could toward the end of the section. We've got plenty of time for questions, and that's how I find that they're really most useful and conducive to the presentation. So let us proceed. Okay. Here is the first area, costing your product or service. I want to talk about 4 subtopics. I'm going to talk about the categories of costs, the goals of costing, which lead to 1 or 2 items that may not be quite so apparent. Organizing the company for costing, or perhaps more accurately, how the company's organization ties into costing. And finally, that bugaboo, the cost that everybody wants to know what it really means, depreciation. It isn't what you might think it is. So let us begin. Taking a moment for the, okay, that's how I'll advance the screen. The first point I want to make is that costing isn't pricing. The pricing of your product is not determined by the market, and it should not be determined by the accounting department. It should be, rather it is determined by the market, not by the accounting department, and not by the cost. It is the responsibility of your sales and marketing people to price it for optimal revenue and acceptance. Unless you are on a government contract, a cost plus government contract, which many will say is a license to print money anyhow. But I would bet that probably most of you are not. Cost is used to manage the production process in order to optimize profit and quality, but not to determine the cost. Except, of course, to make sure you're covering your costs and making an adequate profit. Let us move on. When I look at a company, I always revert to this drawing. I'm just a dumb accountant, I think sometimes, and I like to use pictures to explain things to myself. I put this up on the whiteboard of every class I teach. Costs in a company are divided into 2 basic categories: product costs and period costs. Think of a 2-building company, the factory and the headquarters and support building. Everything that happens in the factory is necessary to create the product that is ready to sell. You can see the little car that's come out of the factory. Everything that happens in there, all those costs, all those resource consumptions, they are product costs. And they comprise ultimately the item on the profit and loss statement. We'll talk about that in a few minutes. That item on the profit and loss statement called cost of goods sold. On the other hand, everything that happens outside the factory, presumably in the headquarters building, whether it's headquarters or support departments, are period costs. They comprise operating costs, a different item on the profit and loss statement. And with that distinction in mind, I'd like to go a little deeper and explain what are the costs that make up these 2 categories. So here we have the 2 categories, product costs and period costs. Imagine first, for product costs, imagine a factory. You've got direct material, direct labor, and indirect overhead. These are the traditional divisions of product costs, still used today about 150 years after they came into vogue as industrialization took hold in European and American industry. As to what the difference is between direct and indirect, we will get to that in only a slide or 2. But first, let's summarize the period costs. There are sales and marketing, general and administrative, and financing and taxes. And these have their own places, again, in the profit and loss statement. Before we go on, though, just to help everybody keep a clear idea in mind, I want to ask you a question, and I'd like you to put your answers into the chat section, please. What kinds of items, what specific kinds of costs do you think comprise sales and marketing? Not general and admin, not finance and taxes, but sales and marketing. type in your suggestions, please, into the chat section. I'd like to know what you're thinking. Give you about 15 seconds to do this. I've been asked to repeat the question. I certainly will. What specific costs, what specific expenses do you think are included in sales and marketing expenses, period costs? Got advertising, that is correct. What else? Ads again, that is correct. Anyone else? Salaries. Someone typed salaries. Which salaries in particular? Whose salaries? Christian? Printing, website development fees and maintenance. Joyce, I would say that yes. Christian, salespersons, yes, I would agree. Anyone else? Well, I think that'll do it for now. You're absolutely right that advertising and marketing expenses are part of sales and marketing, and that salespersons' salaries are also. But are salespeople only paid salaries? Oh, Tanya, not Christian. My apologies. Thank you, Tanya. How else are salespeople paid besides with a salary? Any thoughts? Give you a few seconds to type it in. Commission and bonus from Andrew, absolutely correct. But there is one more large item that no one has mentioned in sales and marketing. And let me tell you what it is. And you may be a little surprised. It is shipping and delivery. You might recall, and I'm not sure if I can go backwards. Yes, I can. I will go backwards. To this diagram, you can see the product ready to sell having been driven out of the factory. You can see it on the right being shipped to the customer. The shipping, the delivery of the product is not a product cost. It is an advertising cost. And why, you say? Because it is necessary to get it to the customer. You're correct. It is necessary to get it to the customer, but it is not necessary to have the product in finished form ready to sell. I like to think of this example. Imagine that the Ford factory, I think it's in Flint, Michigan, is building Ford Explorers, and they're going to sell the identical Ford Explorer to a dealership down the street and to Bob Baker Ford in El Cajon. Putting weather considerations aside as to what kind of features the car has, if they're going to sell the identical car to both dealerships, and of course it's the dealership, not the driver, who is their customer, then that Ford Explorer should cost exactly the same to produce no matter who's buying it. It will cost a lot more to ship to El Cajon than it will to ship to Flint, Michigan. But that's why the delivery cost is not a product cost, in order not to confuse the understanding of what it really costs to make that product. So back to where we were, sales and marketing are the advertising, marketing, compensation for the sales force, and shipping and delivery costs. Those are the big sales and marketing costs in the period costs. Now, I don't like to read my slides, and I don't like it when other people read them. So I'm going to give you about 15 seconds to read this description of what the difference is between direct and indirect. The key is whether costs are traceable to a specific unit of output. That specific unit of output may be a single unit if it's a car. It may be a production run if it's a bunch of little items, or say an example of continuous production like an oil refinery or a grain milling operation. But it is a specific unit of output. And as I say here, Ford knows which engine and which transmission went on which chassis. And they know exactly what they paid for that engine and that transmission. What they cannot say is which volts and amps of electricity generated which photons of light coming out of the overhead lighting fixtures that allowed the assembly workers to work on one car or another. So those are the indirects. If you can't trace them, or if it just isn't worth tracing them, they probably could trace the glue they used to glue down carpets, but it's probably not worth doing. Those then are indirect costs. And we'll have more to say on those in a minute. The goal of costing, of course, is completeness. So let me really jump down to the bottom. A product's cost has to be complete, and therefore all the costs that go into it, all the costs that occurred in that factory have to be absorbed, and that's really the term, absorbed into the total costs. And record keeping is not difficult to make sure that the direct costs are counted in a unit of production's product costs. But we need a way for the indirect costs to be absorbed into a specific unit of output. They need to be allocated. And I want to talk briefly about how that is done. Any production process or any service process is typically divided up into direct and supporting cost centers. The direct cost centers are the ones where direct costs are incurred, the various assembly or service cost centers. So the direct cost centers are tracked easily. The direct costs of material and labor are tracked evenly. Any kind of indirect costs are summarized in that cost centers, but they aren't put directly into specific units of production. Instead, they're added via an overhead burden rate. Now, I don't want to go into how that works. In my cost accounting class, we spent 3 weeks on this. You're welcome to take the class. If you're curious, better you should ask your own accounting people. But that's how the glue, for instance, that is expended in the interiors work center in the Ford factory, or the bolts that are used to add the bolts and the washers that are used to secure the transmission to the chassis are probably costed in the first or second assembly step. As for the non-assembly, the non-direct cost centers in a factory, like production administration or maintenance, of course, all of their costs are indirect. And those costs are allocated out to the direct cost centers through some kind of rate or proportional amount. It will vary by different kind of cost. And then those overheads become part of the burden rate that the direct cost center applies. I know I'm being terribly abstract, and I wonder, have I succeeded in putting any of you guys to sleep yet? You can let me know. No one is saying they're asleep yet. Well, it's at this point, I'm glad you like it. It's at this point in a lecture that I usually ask, if you're not asleep, what's wrong with you? Because admittedly, this is dry stuff. It's important. It's empowering, but it's dry. I like to say that accountants are storytellers. Our stories don't quite rate with those of Shakespeare or Garrison Keillor, but they're important stories all the same. And we simply have to endure the fact that they're not quite as exciting, but they're very important and empowering. And I'm glad you're still with it. Let us continue. One more slide on this overhead allocation. 3 different scenarios. The simplest one is an operation where there's only one cost center. Maybe there are no cost centers, then by virtue, there's only one cost center. All the costs originate within it. You don't need to do any overhead allocation. You just need to figure out a way to divide up the costs by all the units of output. Maybe you do it on average, especially if all the units of output are very similar. Then there's the complex situation. that you'll find in most manufacturing and even in most service firms. Multiple cost centers, multiple direct cost centers. So this is what I just explained. You've got the indirect overhead costs being allocated from the support cost to the direct cost centers. Additionally, and then they get blended in to be part of that overhead burden rate that I talked about. Now, something you probably aren't experiencing, but I want you to know it's there, is that there are even more advanced costing methods. The one we all get taught in cost accounting, and the one that I teach, is something called activity-based costing. This is very useful when the indirect cost centers' own activities really vary depending upon different customers are being served or different products are being made. This can happen in some companies, and if it is, the proportional allocation may not really represent how much of that indirect cost a given customer uses. So the activity-based costing makes a much more articulate representation of that. In my cost accounting class, we always do a problem that shows how much the three categories of customers for a wholesale grocer really contribute to the profit because of their different costs if you use activity-based costing versus simply applying their costs on an even rate across all the customers. It's really eye-opening. Again, I invite you to take my cost accounting class if you're really curious about this. And if you do, let me know you saw this webinar. I'm afraid that won't help your grade any, but at least you'll have some idea of what's coming. Here's a schematic that shows you what I mean by this complex, the middle scenario. You have on the left in the 3 boxes, 3 direct cost centers. You have on the right in the 2 boxes, 2 supporting cost centers. All of the cost, and this is in the factory building, all of their costs added up on the right comprise the total costs of goods manufactured or services provided. Direct materials and direct labor used in the 3 direct cost centers go directly into it. Those are the downward blue arrows and are charged to the specific work orders that are being put through those cost centers. Yes, every assembly job, every production job, every service job is tracked by a work order or a job order. The indirect costs that are incurred within each of those cost centers, the glue, the washers, the wiring. Who's going to cost out 4 feet of wiring, for Pete's sake? Are part of the burden rate that gets added on to the cost, usually as a function or a multiple of direct labor. At least that's how we've traditionally done it for 150 years. And then all of the costs that are incurred in those supporting cost centers, production administration, facilities support, and so on, they all get summed up and allocated in total out to each of those direct cost centers proportionately to become part of the overhead burden rate as well. The point is, we want to know for each unit of production, what is the total cost, so that we can determine whether we're making an adequate margin over that cost when we sell the thing. Last topic under costing. What is depreciation? At the risk of reading my slide, folks, it's not the same as how much less your car was going to get you for a trade-in than it would have last year. Not at all. That is the economic or popular definition of depreciation. In accounting, it's different. For one thing, accounting doesn't give a fig about the market value of anything. It only cares about the historic cost. What did you pay for this thing? So depreciation in accounting is the period by period, that can be month by month or year by year, expensing of the total cost of a capital asset, that is an asset that's expected to last more than 1 or 2 years, over its entire life. It doesn't care. Accounting doesn't care what happens to that asset's market value over its life. So here is an example that I think will clarify that. Now, if the computer screen I'm using were turned 90 degrees to the left, you would see my bookcase and you would see a bunch of model airliners on it because I'm an airline freak. I never worked well, I did work in the industry in air freight in my younger days. But because of that, I like to use airline examples. So let's say we're going to start an airline. We're going to start UCSD Airlines in order to take UCSD students and faculty between San Diego, Los Angeles, and the Bay Area. And occasionally to Merced and Davis while we're at it. And let's say we buy an airplane. Should be pretty easy to get a 737 MAX once they're allowed back up in the air for only $25 million. And let's say, and this is pretty reasonable, we think that plane is going to have an operating life for 25 years. Okay, so we put the plane into operation, we start running the airline, and after a year, we're going to publish our results. How much income did we make? So here is our income statement for the first year. We sold $5 million of tickets. We spent $1.5 million on fuel. I made this example up a few years ago, so we probably are spending a little less right now. We spent $1 million on salaries, $750,000 on maintenance, $250,000 on landing fees and others. Did you guys know, by the way, that it costs money to land an airplane at an airport? And you will find this in airline financial reports. And it costs money to store and park the airplane in an airport too. And then finally, depreciation. What? Well, let me ask you. We've got an aircraft that costs $25 million. How do we account for that $25 million? How do we report the effect of that $25 million on our operating economics? Does it make sense to expense the entire $25 in the first year against the $5 million of revenue? Not if we expect the plane to continue being used to generate revenue over its 25-year life. So in this case, we are going to take 1/25 of that acquisition cost and expense it every year against the revenues that that plane generated. There are other formulas we can use, and we don't need to go into the detail of that. And again, you're welcome to take my cost accounting class and learn those particulars, but this is the general idea. You want to find out how much of that resource, that aircraft, are you consuming every year? And accounting only cares about what you spent on it. So accounting is saying, you have $25 million total lifetime productive capacity in this asset. This year, you used $1 million of it. So after the first year, you got $24 million left. By the way, that does not mean you're not allowed to fly the airplane after it's fully depreciated. You can keep using an asset as long as it's productive, safe, and sensible to use it. As a matter of fact, oh, excuse me, I've lost my sharing. Going back to it. There we are, my apologies. Let me make sure that you're all still seeing the screen. Can you see the screen now? Okay, good. Thank you very much. My apologies for that. Put this back in the slideshow. So, as a matter of fact, Northwest Airlines, which became part of Delta about 10 years ago, especially back in the 1970s, was famous for flying planes for a very long time. And that's one reason why in the 70s, it was highly profitable, because it had completely depreciated their planes and was experiencing much less of that depreciation expense than other airlines. Final note on this profit and loss statement: you may have an operating income of $500,000, but your operating cash flow is more like $1.5 million, because that depreciation expense is not a cash expense. You don't write a check for depreciation like you do for fuel or labor or maintenance or landing fees. You wrote the check to Boeing Company for $25 million, but it doesn't show up as an expense. Only a portion of it every period shows up as depreciation. The last couple of points I want to make before I open up for questions for a moment is that costs are different from expenses in accounting. We use the same term in general life, but in accounting, costs are the value that you gave up to get something. That includes purchases. Expenses are the use of that resource. You may use it upon acquisition, like the labor that you pay to your researchers, or you may not use it until later. You may have the cost of creating products, but that's not an expense until after you sell them. And you may not sell them in the same period that you make them. So you may not experience the expense of the cost of goods sold in the same period that you experience the cost of goods manufactured. More on that, I invite you to take the accounting course. But it's an important distinction. I wanted you to be aware of it. Finally, the goal of costing is not to minimize product or service costs. You want to, of course, not spend them unnecessarily, but it is in order to identify the resource costs you need to incur in order to deliver the product that provides the value your customers are willing to pay for. And use that cost information to manage and optimize your operations. Any questions on costing here? Give you about 20 seconds if you want to put them into the chat. Well, I'm not seeing any questions, so I guess you're all ready to take the final exam in my cost accounting class. Let us go on. Using accounting effectively. Two general topics I want to talk about here: the finance and accounting function itself, and then the basic financial statements that it generates. I'll let you read this. These are the basic tasks that finance and accounting performs. Now, a lot of these may be a little unfamiliar to you and hard to keep in your mind. Let's take another look at this and look at the cycles that these tasks occur in. That might be an easier way to think of it. So first of all, the first cycle is the monthly close. Every month, your accounting department should, it is called, close the books and report the results. What does closing the books really mean? It means after the last day of the month, no more transactions, no more operational transactions are entered into the accounting records for that month. All the activity has been recorded. There are more entries that are made in order to finish the job, but no more operating activities. Then there's annual budgeting and forecasting. Budgeting is annual. Forecasting can be done 1, 2, 3 times per year, depends upon the firm. In my company, we do 3 forecasts a year. Our fiscal year runs October to September. We do our budget, we're doing our budget now, and then we do our first forecast in November, and the two other forecasts a few months and about 6 months later. The forecasts are just in order to give management an updated idea of what the year-end numbers are going to look like. Incidentally, I mentioned the fiscal year. Probably most of your companies operate on a calendar year for their fiscal year, but a company doesn't have to. Time is an abstract and artificial construct. Most government and not-for-profits, as a matter of fact, operate on a July to June fiscal year. Most retail companies, well, you tell me, what do you think is the typical year end for a retail company? It's not December 31st. Enter your thoughts in the chat section, please. This will wake you up. Anyone got a guess? Anyone got an estimate? When do you think Walmart closes its year? Someone said June. April is another one. And someone said March. Let me ask you this question. You want a fiscal year to end, and then someone said February. You want a fiscal year to end, if possible, if the operations of the company are structured this way, after the company's annual operating cycle finishes. Now, many companies don't have a typical annual operating cycle. Automobile companies do. They sell a lot fewer cars in the winter than they do in the spring and summer. Retail companies have an operating cycle. When is the period of peak sales for most retail companies? Christmas, of course. So do you think that a retailer's fiscal year should end in December? One might think so, but actually most retailers' fiscal years end in January. Why? So that the returns and exchanges after the Christmas season are accounted for in the same year as that Christmas season, and they really have a very clear idea of what they sold and for how much. So Penny's and Walmart and I think Walmart and Macy's typically end their fiscal year in January. There is a company in San Diego that used to be publicly held. It no longer is, it went private. A retail company, if it's still in business, I'm not sure it is, called Charlotte Russe. Charlotte Russe was a ladies' clothing company, and its fiscal year didn't end in January. Its fiscal year ended in September. Why then? Well, it turns out Charlotte Russe typically sold to the 18 to 25-year-old demographic. And when do women of that age buy the most of their clothes? They buy it in anticipation of the new school year. So by the time September has started, their customers' major buying season and Charlotte Russe's major selling season is done, or was done if they're still around, not around anymore. So they ended their fiscal year in September. An interesting difference. Back to the accounting cycles. So you have budgeting and forecasting. Then you've got regular and ad hoc investor relations communications for companies that are either publicly held or have multiple investors. And finally, you've got ad hoc transactional support, analysis for new financing, capital expenditures. This is really the most interesting stuff we do, I think. Those are the four major events in terms of calendar cycles that accounting and finance have. Now, since I talked about financing, let me show this to you. Those of you who are active entrepreneurs, you've started a company or you're starting, actually, no, I'm ahead of myself. Apologies. That's the next slide. This slide is one where I want to ask you more questions. these accounting and finance duties imply a hierarchy of financial authority and responsibility within the company. Let me ask you to put into the chat, please, what group of people, what area in the entire company is responsible for corporate governance and investor relations? Let me see your answers, please. Who is responsible for those things? Someone said C-level, and someone else said the board. Anyone else? Well, my congratulations to the person who said the board. Many people will answer the C-level, the executives, but actually it's the board of directors. They are the voted representatives of the shareholders. They are analogous to a legislature within the company. They delegate the day-to-day tasks to management, but it's the board who's responsible for representing the owners and governing the company, just like Congress is supposed to be responsible for representing the voters. All right, and then what about the activities of capital investment and financing? For instance, UCSD Airlines buying this airplane. Who has the authority to make that decision? Who has the authority to approve whatever financing is going to be generated to pay for it? Again, attorney and CFO is one person. Well, the corporation is the company, someone answered. I want to know what group within the corporation structure has that authority. Anyone else? I thank you for participating. Let me give you the answer. Again, it's the board. And think about this. Think about this as a shareholder in UCSD Airlines. Do you want to lose control, even indirectly, with how the company spends the money you have invested in it for major assets, or whether the company puts you at greater risk by borrowing? No, that is authority that only the board has. They will delegate to management the authority to make those decisions for specified amounts, maybe up to $25 or $50 or $100,000. But the board, if you're talking about hundreds of thousands or millions or tens of millions of dollars, it's the board that has to approve that. Management is responsible for making those investments, for executing them, and for safeguarding the assets. I don't know if this might be a sensitive subject for some people, but you might have seen the headline in the San Diego Union Tribune this morning and yesterday, that an internal audit of the Sweetwater School District revealed that management had misled the board on what the financial performance was. And that's why management is now in serious trouble with that board. They didn't tell them the information they really needed to make a decision. Decisions like executing and approving a bond issue that maybe they shouldn't have, or shouldn't have in its form. All right, so if it's the board of directors that has the responsibility and the authority in those two categories, what is the responsibility? What is the purpose of the finance function, which of course is headed by the CFO? Let me give that to you directly. The purpose of the finance function is to ensure that the company has access to maximum capital at optimal terms at all times. That's why it publishes or makes available financial statements. That's why it is always accounting for its operations, so that if it ever needs to go to the capital markets or to the bank, it can be ready to. You don't want to start setting up an accounting system when you decided you need to borrow $1 million. As for operations, it uses the information provided by the financial and operational data systems. And this financing leads me to the stages of venture financing. This is what some of you entrepreneurs may have seen. First, you hit your savings and credit cards. Then it's family, friends, and fools. Angel investors for up to $3 to $5 million. Venture capital investors for over $3 to $5 million. And if you're really big and you hit the jackpot, institutional investors like mutual funds. But accounting's purpose is always fundamentally to provide information to outside parties, parties who have a legitimate stake in knowing what has been the performance of the company and what are its abilities, at least in the short run, to meet its obligation. In other words, prospective investors or vendors. They have a right to know. And it's for their benefit more than anyone else's that accounting is operating. Likewise, you as the financial manager of your company should be externally oriented and be thinking not about how much the company is paying you in a salary, but how much value you are creating for outside investors, even if you don't have any. So how do you judge this? You look at the basic financial statements, the profit and loss statement, the cash flow statement, and the balance sheet. We're going to look at just the first one, the income statement, or P&L, profit and loss statement. It shows your performance according to the performance formula. Accomplishments minus efforts equal performance on the left. On the right, in terms of finance, revenues minus expenses equal earnings or profit. The company's financial performance, what does it do in terms of, as far as accounting is concerned? It increases or decreases the wealth of the owners by virtue of increasing or decreasing, reporting the increase or decrease of the net value of the enterprise, at least as far as accounting is measuring it. And this excludes transactions with owners because those transactions lead the owners in no different of a net change in their position. Here's the generic income statement. Revenues minus cost of sales, that is the cost of the items you actually sold, whether it's a product or a service, gives you a gross profit, subtracting operating expenses and R&D. They're usually presented separately if R&D is an important component of the company, and in this town it usually is. Those give you operating income. You take out interest expense or financing expense, that gives you pre-tax income. Take out taxes, that the income tax, that gives you net income. That net income is how much, according to accounting, the value of the owner's investment has changed. Think of it, well, here's an actual P&L for my former publicly held employer, Cohu Inc. They're publicly held. I'm not revealing anything. I shouldn't be here. This was a good year. You can look straight to the bottom and see that they made $25 million. And you can see how from the $323 million they took in revenue, various expenses went out to end up with that $25 million. Think of this P&L as a funnel, wider at the top and narrower at the bottom, as each category of expense is deducted. I will let you look at these in more detail later from the PDF stack or by looking at the presentation. The one more thing I want to talk about on the P&L is the logic behind it. Why are the expenses in it presented in this order? Why does cost of sales come out first? Why doesn't income tax come out earlier than it does? It comes out at the bottom. Why doesn't it come out in the middle? Why are R&D taken out after cost of sales and below gross profit? Each of these items, of course, is categorized by their purpose. And here is what their purposes are. Basically, they're measurements of how much your assets went up or down for each of these reasons. Because what accounting is really trying to measure is how valuable is the company. And your value depends upon your assets minus your obligations. And they represent a transfer of value from one party to another. Net sales represents a transfer of value from your customers to you. Cost of sales represents a transfer of value from you to your vendors or to your employees. Net income represents a possible transfer of value from the company to your owners. At least it gives them a bigger claim should they exercise it. And since it's a transfer of value, these items are listed in order of decreasing relationship to the revenue event. The revenue event, trading with customers, is the most fundamental thing the company does. Everything else flows from it. So it's what starts the profit and loss statement. One last thing, here's this thing called EBITDA. What's it? It is a proxy for operating cash flow. You take that operating income, you add back depreciation and amortization, because as you might remember, they are non-cash expenses, and all the other expenses represent things you did spend cash on. And that gives you a real quick substitute for your operating cash flow. You need this number for your elevator pitch when you find the angel or investor, angel or venture capital list you in the elevator, and you've got 30 seconds to impress him or her with your company. The first thing they're going to ask you is, what's your EBITDA? So you have to have this number ready. Any questions on using accounting and financial statements? I think we're getting pretty close to the end of the presentation part. Nathan, I'm going to go to the last slide.
Okay. Yeah, we're a bit over.
All right. 30 seconds for the ending sermon. What is accounting's role in creating sustainable value? I only have one slide on this. Many years ago, I attended a wonderful presentation at the San Diego Venture Group. It was meant to ask the question, is your idea a feature, a product, or a company? Are you starting a venture because it's a company, or are you starting a venture because you think it's going to be a company, but it's only a feature or a product? And if it's a feature or a product, you should license it or sell it and move on. Don't create a company when there isn't one. If you are creating a company, you've got to understand that as the entrepreneur, your goal is to put it in place and make sure that it creates value for your investors. And you may not be the person to head up the company once it's operating. You may be, you may not be, but you absolutely do need to disclose to your investors, and it might not be a bad idea to disclose to your employees, your financial results period by period. A lot of owners, maybe majority owners, are not inclined to reveal their financial results. I can't tell you what to do, but I would ask this question in closing. How would you like to play on a sports team that never knew if it won or lost and didn't know its record at the end of the season? How easy do you think it would be to motivate those players? Well, don't you think that it would be easier to motivate your employees if they knew how the company was doing? Certainly if it had something to do with their bonuses. Most owners think, I don't want to reveal that because I'm afraid my employees will go out and start a competitor. I got news for you. The ones who are going to start in their own company, they're not there now anyhow, or they're already going to do it, and letting them know the numbers isn't going to change that. That's a personality characteristic, not an employee characteristic. Well, that's about it, except for a final recommendation: take my class. It's a good course. I think it may help you. If you have any follow-up questions, here's how you get a hold of me. Nathan, that's
Awesome.
it.
Thank you, Dan. Really appreciate it. A lot of good info in there. Just want to remind everyone, we are going to send out the slide deck, so you will be able to get a hold of this stuff and refer back to it. And if you do have questions, you can follow up with Dan. If anybody does have a quick question right now, because I didn't want to cut people off, we can maybe take one.
Sure.
But if not, you can feel free to follow up with Dan directly.
Well,
So
I
if you
probably
do
put
have
everybody to sleep again.
well,
Thank you, guys.
yes. All right. Well, thank you everybody for attending. I will get a notice out with the slide deck to everybody. And then once it does, the video of this webinar gets posted to our YouTube channel, I will get that out to you as well. So you can refer back to Dan's actual presentation itself. So thank you very, very much for attending. And I hope to see you in the next Small Business Management Series webinar once I get that posted and you can register for it. So hope everybody stays safe, stays healthy, and takes care. All right.
And best wishes to everyone.
Definitely.
Hit them hard.
Thank you. All right. Bye.